I mean, the one thing I will say with total certainty, we're going to be living with more uncertainty. And so with that in mind, we are going to have bouts of fear, which is going to bring down the market. Federal Reserve does not have tools to fix supply problems. The Federal Reserve's tools, like every other central bank, is to reduce demand through higher interest rates. As I said, I don't think we have a demand problem. We have a supply problem. And so if they believe they have to change demand, that will put us into a recession. And I believe we need more time. So I'm under the belief we're going to have a 2-year period of time of elevated inflation.
Markets have had sort of a rocky road, can we say, so far this year. As you look forward, is there any real prospect they can recoup in the second half of the year?
Probably not totally. Let's start off. The market has recalibrated itself. We witnessed now a change in policy in the Federal Reserve. We raised short rates. So we saw a recalibration of growth stocks. That's principally the majority of the downfall. And yet the index are masking some of the problems because part of the index are energy companies, commodity companies that are up quite a bit. So if you look at the volatility in the market and the spread between winners and losers, it's pretty broad this year. And so we've taken out a lot of those gains that we saw during the COVID years and during the 2 years where we were, changing our lives and we were emphasizing different companies, and now we're seeing the reverse impact of that. So that was one of the foundations of it. But now there's greater recognition that inflation is not transitory. It is probably with us for a number of years. And it's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated. Demand right now in our economy is equivalent to the demand that we saw pre-COVID. And so we're witnessing all these supply shocks, and that's creating these attended price increases. And so it's more supply driven. It's been aggravated now, obviously, by COVID and lockdowns in different parts of the world where we are manufacturing goods. It has been further aggravated by the Ukraine Russian war and where we have supply shocks. But I have this fundamental view that much of the inflation has been generated by some very large policy shifts in the United States. I mean, I think the marketplace does not understand the dependency of low rates was on the QE purchases, the trillions of dollars at the Federal Reserve. But let's all be clear, between Japan and China, they own close to $2.5 trillion of U.S. treasuries too. So there are big owners and big players, and obviously what will be the future clearing price rates with less QE and now a reversal? Do we need to get up to a 3% 10-year to meet a lot more demand? And so much of this is we're all going to have to see what are the consequences. If the demand that we saw in intermediate treasuries in May carry on, QE may not be, the reversal of QE is not going to be as big of a problem. If we have that fear that inflation is going to be longer and higher, then obviously we're going to have to reset all that, and we're going to probably have higher rates. But I'm of belief that we don't have to have much higher intermediate and long rates. I believe the problems of inflation are not Fed-related as much as policy-related. So I believe inflation is really based on some big macro policy changes that are now, that had good intentions, but the unintended consequences are more inflationary. For instance, post-World War II, America's foundation of economic policy was based on consumerism. We built this entire economy post-World War II with a belief that if more Americans can have more things, then we have happy Americans, and we built a whole geopolitical platform around that. We changed our immigration policies, and I'm talking about legal immigration, yes. Okay? Our legal immigrations, that was changed about 5 years ago, where we reduced the amount of legal immigration. If you look at the rate of increase of immigrants, legal immigrants in the United States from 2000 to 2017, and the rate that we are growing immigration in the last 5 years, we're down 2 million. 2 million new entrants to the United States legally. Right. That is very inflationary when we have full employment, when we have these jobs. Think about all the need for workers. What is that going to mean when we start implementing our infrastructure bill, when it's going to take up quite a few new jobs? Where are those employees going to be coming from? It's going to create rising wages. And if you look at earnings, many companies are saying rising wages are a part of their degradation of their margins.
And maybe to add to that, we're also going through an energy transformation globally.
Totally.
And that can't be free.
And I've said in my letters that energy transition can be highly inflationary. And I've always said that an energy transition must be fair and just. And we can't be just mitigating supply. We need to be finding solutions. So we have a strong view on that if we don't find a way to be working with the hydrocarbon companies, with the energy companies, making sure that we have adequate global supply of hydrocarbons at the same time, move technology to create a more decarbonization platform and pathway, and it's not going to be a straight line. It's going to be lumpy like what we're seeing now. So that is also inflationary. And let's be clear, the $7 trillion, I want to underscore, $7 trillion of fiscal stimulus during the COVID years is beyond any stimulus we've ever seen in fiscal policy in our history of a country. So you add all those things up, it was a foundation of inflation. And then you overlay the Russian-Ukraine war and the supply shocks, and then you overlay now COVID and the lockdowns and what it's doing for supply chains. All of that is adding on. So getting back to the Federal Reserve and your question, the Federal Reserve does not have tools to fix supply problems. The Federal Reserve's tools, like every other central bank, is to reduce demand through higher interest rates. As I said, I don't think we have a demand problem. We have a supply problem. And so if they believe they have to change demand, that will put us into a recession. And I believe we need more time. So I'm under the belief we're going to have a 2-year period of time of elevated inflation. But I do believe as we reconstruct our supply chains, and we find better sources of energy in the interim, as we create more decarbonization technology, all of this in 3 or 4 years is going to work itself